There are big changes coming to your 401k, HSAs, Social Security, Medicare, inherited IRAs, and taxes, plus more. And that's what we're going to talk about on today's show.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and your retirement. I'm your host, Scott Searins. For those that are new to the podcast, I run a retirement planning and investment management firm where we help people retire, manage their investments, reduce their taxes, all so that they can maximize their retirement story. Today, we're talking about big changes in 2025. That's right. What are the big changes that are coming down the pipeline in 2025? So whether you're already retired or whether you're pre-retirement, 5 years away, 10 years away, looking for that retirement date, we're going to talk about what's new in 2025 when it comes to your 401k, when it comes to Social Security, Medicare, HSAs, if you have an inherited IRA, and as well, we're going to talk about the tax brackets. Now, speaking of big changes, just wanted to give you a heads up. As you know, if you've been listening to the show, my wife and I have a big change on the way as well, where we are expecting our little baby girl at the end of the year. Now, of course, she could come before then. She might hang around a little bit after her New Year's Eve due date. We'll see. But anyways, we were expecting a big change ourselves. So just wanted to give you a heads up that when our baby girl is born, probably going to spend some time focusing on family, of course, continuing to focus on our clients, continue to focus on new people that have approached us to help their retirement plans, but might take a little bit of a break here from the podcast for about a month and a half or so. So just wanted to give you a heads up on that. So if you're wondering, hey, where did that next show go? I can't find it in my podcast player. Well, most likely that's why our little baby girl arrived and we're spending some time focusing on family. So we appreciate your patience and of course look forward to being back with you shortly after that to provide some more great value and benefit regarding your retirement. All right, so let's dive into the big changes for 2025. I'll talk about how they may impact you, how you can maybe use them to your tax benefit. But there's a lot of detail here. So you'll see me taking a look at my notes. I want to make sure I get the numbers right for you as we go through. Now we're going to start with 401ks. Well, 401ks, 403bs, 457s. They did announce that the contribution amount that a person under age 50 could put in 2024, it's $23,000. In 2025, it's $23,500. Now, if you're age 50 and above, there's still the catch up, but they did not change this amount for 2025. It stays at $7,500. Again, anybody that's age 50 plus. So the total amount, if you're age 50 plus, that you could put into your 401k, 403b, 457. And of course, speak with your plan sponsor because every plan is different based on, I'll call it earnings and income within and salary levels within the plan. But total now, age 50 plus, $31,000, or under the age of 50, you could put in $23,500. So look at that as if you're somebody that's looking to catch up on your retirement savings, or if you're a high income earner, or if you're thinking your taxes are going to be a lot higher in the future and you need to get some more tax-free money saved away. This is a way to put more money then into your 401ks, into your Roth 401k. All of these rules also apply to that Roth 401k. So if you're looking to save that tax-free money, here's the addition ways to do it. Now, this is new. So this actually is a very big change for 2025. If you were age 60, 61, 62, or 63, I know, really weird age range there, but if you're age 60, 61, 62, or 63, instead of the $7,500 catch-up amount, you actually have the ability to put more in your retirement savings. So the government's really trying to help you say, hey, we understand if you need to catch up for retirement, if you need to put more in your 401k or your 403b or your 457, we're trying to give you that ability to do so age 60 through 63. So instead of the catch up of $7,500, it's a catch up of $11,250, therefore giving you a total of $34,750 that you could put into your 401k or your Roth 401k. Now, another change for next year is that the Secure Act is also putting into place what they call auto enrollment. So depending on when your plan was started, if you're just getting into the 401k at a new company, it's going to auto enroll you that at minimum, you're putting 3% into your 401k. I think this is a great thing. It's going to really help people save. However, if you're someone, and I have a few clients in this particular scenario where one spouse is working, one spouse is already retired, and what we've decided is that the spouse that is still working, they just want to get the company match and that's it. Or if there is no company match, they might not be taking anything out at all because, again, they're trying to maximize their income through the one salary since one spouse is retired. So you want to be careful about this because they may auto-enroll you. And then also it includes escalation. So auto enroll plus escalation, more is going into your 401k. So again, in your situation, for most people's situation, this is going to be a great thing. It's going to get them saving more for retirement. But also understand, take a look at your situation. It might be auto enrolling you when you've been trying to opt out. The other thing that the Secure Act enacted for 2025 is that the U.S. Department of Labor needs to create a, call it, search system for orphaned 401k plans. So if you're kind of wondering, hey, where did my old 401k plan go? You didn't keep track of any of the paperwork. You weren't sure which institution it was with or where it might even be now. The U.S. Department of Labor is supposed to be creating a search system where you will be able to search then for that old 401k plan. Now, not necessarily 401ks, but along the same line as retirement savings, then are those IRAs and Roth IRAs. Now, really no changes when it comes to for 2025 for IRAs and Roths. Under age 50, you still have that contribution limit of $7,000 a year. Over age 50, the catch up of $1,000. So age 50 plus, $8,000 a year that you can put into your IRA or Roth. And under that amount or under that age is the $7,000 that you're able to put in. So all of these different items, well, I'll say primarily the contribution limits. Take a look at these, understand these. Take a look at your 401k contributions that you're putting in. Now, if you were previously, maxing out, but based on the contribution limit that you had in, now that the limit is going up, you may need to adjust your percentage in your 401k. So at the end of the year, take a hard look at things. Do you need to kick your 401k contribution up a notch to make sure that you're putting in the most that you can if you're looking to either A, get that tax deduction, or B, go into the Roth 401k where you're trying to save that money and get that tax-free money for your future. All right, next let's dive into Social Security and Medicare. Big changes for 2025. You've probably already heard, but just to recap it, the Social Security COLA, cost of living adjustment, is 2.5%. So if you are taking Social Security, you should see a 2.5% raise on your Social Security come the start of 2025. Now, I get this question all the time. People say, well, what if I'm not taking Social Security? Should I start it so I get that cost of living adjustment? If you're not yet taking Social Security, they are factoring those cost of living adjustments into your Social Security that you're not yet taking. So don't worry, it's being taken into account if you're not yet taking Social Security. The max benefit that somebody could receive at their full retirement age goes from $3,820 a month to $4,018 a month. And then the wage cap, so for those, I'll call it high income earners, the wage cap of how much of your income gets taxed for Social Security goes from $168,600 in 2024 to $176,100 in 2025. What does that mean? Again, the first $176,100 will get taxed for, the Social Security tax will apply to that amount. Anything above that amount, there won't be a Social Security tax on anything above that amount. Now, for those that are under their full retirement age, collecting Social Security, there's always been an earnings limit. And if you go over that earnings limit, then you get a reduction on your Social Security. So the earnings limit has gone up. Now there's two parts, two portions, two time frames. Let's go with time frames. There's two time frames of this earnings limit. There's prior to the year of full retirement age and then the year of full retirement age. So let's start with the first time frame. And I've got a video on this actually. We'll link to it in the show notes if you're looking to understand this deeper, meaning working prior, taking Social Security prior to full retirement age and still working. Again, your Social Security could potentially be reduced. So it's all based on the earnings limit. Prior to full retirement age, 2024, the amount was $22,320 a year. That is going to go up to $23,400 a year in 2025. So over that limit, you could potentially then see a reduction in your Social Security. And again, this is only at pre-retirement age. The year of your full retirement age. The year of your full retirement age, it was $59,520. That will go up in 2025 to $62,160. So just have those amounts in mind if you're taking Social Security prior to full retirement age and still working. That's when you could potentially see some reductions on your Social Security. Now, guess what happens? Social Security goes up. What else goes up? Medicare goes up as well. So Part B, standard monthly premiums, 2024 is $174.70. In 2025, that's going up to $185. So yes, unfortunately, other things go up when your Social Security goes up. Now, some really good rules coming out in 2025 is for those with prescription drug plans, those Part D prescription drug plans. A big change for 2025 is that there's going to be a $2,000 out-of-pocket maximum. Again, those with Part D prescription drug plans, $2,000 out-of-pocket maximum. So if in the past you've been paying on prescription drugs and you've seen out-of-pocket $3,000 or $4,000 or $5,000 on those prescription drugs, a really good rule that they've passed is now it'll be a $2,000 maximum. At that point, you still get your prescription drugs, but you're no longer going to have to owe for those prescription drugs. So super helpful. Just be aware it does not apply to what they consider Part B drugs, those that are administered at the doctor's office. And the last part here is the Part A. This is the hospital part. Part A deductible. In 2024, that was $1,632. In 2025, $1,676. So the big thing there is knowing that, first off, your Part B premiums are going up. But more importantly, if you do have prescription drugs that you're paying for and you felt that the costs have been super high in the past because you're paying over $2,000, just know your new cap will be $2,000. Next, let's talk about taxes. Then we'll wrap up with health savings accounts and inherited IRAs. So each and every year, the IRS publishes their new income thresholds, basically new marginal rates, and the thresholds for those marginal rates go up each and every year. So I'm not going to go through all of those thresholds. We'll make sure there's a link to basically all of the information that I'm talking about in the podcast today. We'll put different links in the show notes or in the description. So feel free to look there, look at the different links. We'll have links for the new thresholds for the marginal rates. But the big ones I want to talk about are the ones where you really jump up into kind of new rates. When do you jump from the 12% into the 22%? When do you jump from 24% to 32%? So let's go first from 12 to 22. If you are single, that takes place at $48,475 of income. If you're married filing jointly, it's $96,950. So that's very good to keep in mind. For instance, if you're doing Roth conversions, if you're bringing in income, if you're trying to hit certain deductions or charitable givings to get you in certain brackets, keep those two income thresholds in mind, because if you pass those thresholds that I just talked about, 48,475 or 96,950, you're jumping from 12 into the 22% bracket. The next is from the 24% to the 32% bracket. Again, single, that jump is going to happen at $197,300 of income. Married filing jointly, that happens at $394,600 of income. We're crossing those income thresholds. Now the dollars that you have above those thresholds are going to get taxed at that 32% bracket rate. Now, good news is, just like every other year in the past, in 2025, the standard deduction that one would receive on their taxes is going to go up as well. For somebody filing single, $14,600 jumps to $15,000, and married filing jointly, $29,200 jumps to $30,000. So what does this mean? Well, that is the standard deduction that the government, the IRS, gives you on your taxes. So a lot of times what you want to compare this to is your itemized deductions. If your itemized deductions are higher than those amounts, then you'd want to go with itemized deductions on your taxes. If your itemized deductions are not surpassing those amounts, well, there's no real reason then to maybe track them, because you're going to get the standard deduction on your taxes. Now, just be aware, 2025 is when the Tax Cuts and Jobs Act is scheduled to expire, at which point at the end of 2025, all of these tax rates could potentially change, unless the government does something to keep them intact. Continuing on with the tax changes here, the other thing listed on the IRS website was the FSA. So if you have a flex spending account, in 2024, you're able to put in $3,200. That will be $3,300 next year. So if you're still in your last time period of open enrollment, trying to make your decisions, just know that you can update that number for next year. And then we've got federal estate tax exclusion and gifting exclusion. So the federal estate tax exclusion goes from $13,610,000 up to $13,990,000. So if you are potentially facing federal estate taxes in your future, now those are per person if all of the right form work is filled out, but if you're facing federal estate taxes, know that that's gone up, and speak with a financial professional, speak with an estate planning attorney on how you can utilize these increased exclusions, because at the end of 2025, those are also scheduled to expire with the Tax Cuts and Jobs Act, at which point it would potentially get cut in half. The other thing is the annual gifting exclusion. Now, this is money that you are able to gift to another person without filling out any sort of tax forms. In 2024, it was $18,000. That is getting bumped up to $19,000 in 2025. So you're able to give $19,000 to another person without filling out any sort of tax forms. It's the annual gift exclusion. Now, be aware, if you're going to take it out of your IRA and put it in your checking account to give to that other person, you are going to have to pay taxes because you're pulling it from your IRA. Why would somebody want to do this? Well, back to that, federal estate tax exclusion. Maybe you've got a lot of money in your estate or in your accounts that you need to start getting out of your accounts. Maybe you want to help somebody out. Maybe, fill in the blank, but there's a lot of different reasons that you may want to gift to somebody else to try to get tax dollars out of your tax situation and maybe onto somebody else's. All right, so let's wrap up talking about health savings accounts and inherited IRAs. No, they're not connected. We're going to talk about them separately. Let's start with the health savings account. As you know, probably listening to this show or seeing videos on our YouTube channel, this is a favorite account of mine because of the triple tax advantage. You put money in, you get a tax deduction. You can invest it so it can grow tax-free. Then if you use it for qualified medical expenses in your future, those also go out towards those funds go out to those qualified medical expenses tax-free as well. Great account, great to be able to utilize for medical expenses, Medicare, used for a lot of different expenses in your retirement to help keep your costs down. So the HSA, now health savings account, you have to have a high deductible health plan to be able to contribute to an HSA. Again, talk to your employer, see what they offer, see what they have. A lot of times you need to do this during open enrollment. So you might have a few days left to, make all these changes before the end of the year. For those with self-coverage in 2024, you were able to put in $4,150. In 2025, that's going up to $4,300. Those with family coverage, 2024, $8,300 that you could contribute. 2025, $8,550. And if you are age 55 plus, there is a $1,000 catch-up. That did not change from 2024 to 2025. So think about that. That is money that you can get a tax deduction for. So people ask me all the time, hey, how can I help my taxes? Where can I get a tax deduction? What can I do? And a lot of times when we look at their situation, they're not maxing out their health savings account. That's almost an account, in my opinion, better than a Roth IRA, because you're going to have Medicare in your future. You're going to have health expenses in your future. You can get a tax deduction. It can grow tax-free, and you can use the money tax-free as well. So there you go. That's me pounding the table on the HSA. I think you know and see the importance of it. And if you are utilizing it, see if you can max it out. See if you can get those extra tax deductions on your taxes and have all that great tax-free money to use in your future. Then the last thing I want to talk about is the inherited IRA, specifically to those that are non-spousal beneficiaries. So inherited IRAs, if you're a non-spouse beneficiary and inherited the IRA within the last, let's call it, couple years here, there's been kind of some confusion over the last few years of whether or not you should be taking a required minimum distribution. So again, if you inherited your IRA 5 years ago, 6 years ago, 7 years ago, 8, 9, 10, or longer, this does not apply to you. This applies to those that inherited the IRA where you have the 10-year rule. So if you're like thinking, wait, am I able to take lifetime RMDs? This doesn't apply to you. But if you're subject to the 10-year rule, this does apply to you. There's been a lot of confusion, and so the IRS has said for the last few years, well, we won't penalize you. We won't penalize you. The confusion came basically for those people where the person that passed away was taking RMDs. Would the person that inherited be subject to RMDs? Well, the past few years, the IRS has said, you know what? Some confusion in the writing, the law, etc. We won't penalize anybody if they did not take the required minimum distributions. Well, in 2025, they've made the rule very clear that if the person that passed away was taking required minimum distributions, the person that is inheriting it needs to take required minimum distributions as well. Now, there's, of course, certain exceptions, exclusions to the rule, but I just want you to know, go talk to your financial professional, talk to your tax professional, make sure you're doing the right things in 2025, especially if you weren't, doing that in 2024 or 2023. And with this, a lot of this is planning around your tax situation. So you want to do what's best. If you have to take the required minimum distributions, can you take more? Certainly, you want to do what's best for your specific tax situation. So there we go. That was it. Tons of changes coming down the pipeline for 2025. I hope this helped you understand them, think about them, utilize them. Hey, I want you to kind of think about, is there any ways that you can utilize them to help get you additional tax benefits, additional tax-free money? Or should you know where different thresholds stand for Roth conversions or in regards to Social Security and working? Hopefully going through this, talking about them, understanding where they might, fit into your situation, hopefully found some value and benefit in that. So if you've enjoyed today's show, we look forward to future shows where we're helping you out on retirement savings, retirement planning, helping you understand how to reduce those taxes on your IRAs and 401ks. Subscribe to us on your favorite podcast channel or to us on YouTube. That way you get notified when we come out with our next video. Thanks. Have a great day.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Management, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed.